future of crypto exchanges after FTX demise. The fall of FTX sent shockwaves through the cryptocurrency markets. SBF filed for bankruptcy on November 11 on behalf of FTX. The filing also listed FTX's American subsidiary, FTX US, and sibling trading desk Alameda Research. The formerly $32 billion cryptocurrency exchange, which was founded in 2019, appeared to be unstoppable as the second largest exchange behind Binance. Some of the wealthiest figures on Wall Street and Silicon Valley were investors. But in the end, reality set in for FTX, and its millions of clients witnessed the sudden disappearance of billions of dollars. So what went wrong at FTX, and what impact will these events have on cryptocurrency markets? Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. Now, without further ado, let's start. Similar to a traditional stock exchange, FTX served as a platform to match buyers and sellers of a certain asset. In this context, digital currencies like Bitcoin and a specific class of financial contract known as derivatives. But as it turns out, FTX accomplished a bit more than that. According to reports, the company used client funds to finance risky transactions executed by its sister company Alameda Research. To transfer money to their FTX trading account, some clients sent money directly to Alameda, raising suspicions that FTX and Alameda could have mixed up the money. Additionally, FTX has a token named FTT. It operated very much like a loyalty program, rewarding traders with benefits like discounts on trading fees. According to one account, Alameda had a significant amount of FTT and even utilized the token as security for loans from other cryptocurrency companies. This led to concerns about FTX's financial stability. The value of the FTT token skyrocketed when competitor company Binance's CEO said in a tweet on November 6 that it was selling the majority of its FTT holdings. Customers then started to leave FTX in great numbers as a result of that. Unexpectedly, on November 9, Binance made an offer to buy FTX, only to withdraw it the next day after reviewing the company's financial records. Sam Bankman-Fried, the company's CEO, left after FTX filed for bankruptcy on November 11. Bankman-Fried was arrested on December 13 by authorities in the Bahamas. This happened after the US government filed criminal charges against him to hold him accountable. The bankruptcy of FTX meant that Oleg Fomenko, co-founder of the fitness-focused cryptocurrency network Sweat Economy, was likely to lose over $400,000 in cryptocurrencies, including his company's own token, Sweat, USDC, and Tether. These funds were held on FTX by Sweat Economy through two of its market makers. Market makers serve as the intermediaries in transactions involving buyers and sellers. So for example, if someone wishes to purchase or sell a token, they aren't left waiting for the other party to trade. In contrast to other market cycles, 2022 revealed the ecosystem's extensive interconnection. In an effort to generate extremely high returns, businesses engage in risky lending activities, taking client funds and investing them elsewhere. They put up volatile, illiquid coins as collateral. The outcome? Several high-profile losses, with the ensuing contagion affecting a large number of companies exposed to those failing businesses. The most notable instance to date is FTX. FTX is the fall from Terra Luna. From that point on, there has been a contagion. There may be genuine exposures that fall under more conventional finance. Marique Flamand is the CEO of the Near Foundation, the company driving the Near blockchain network. Her company was one of those affected by the FTX catastrophe. Truly, the influence of Near and Near Foundation is very little. The $500 million raised between January and April of this year is all fiat money kept in bank accounts. She was nonetheless taken aback when she learned of FTX's problems. Terra Luna was the first shock as a sector, which is astonishing given how systemic this is. It felt pretty confined. However, it was still the industry's first warning. Consequently, what are the effects of this? Since then, executives of competing exchanges have made an effort to convince investors that their platforms won't have issues similar to those that FTX did. They have serious concerns about anyone utilizing the token they produce as collateral or a means of leverage. Binance, however, does not. What should clients think about CRON in your company? You are using your own currency. It was never used by Binance in the same manner that FTX was. Investors started removing their assets from exchanges to reduce the danger of the contagion. After reaching a record of 3.1 million in 2020, there were only about 2.2 million bitcoins available on exchanges towards the end of 2022. In the same time frame, the amount of Ether available on exchanges decreased from 34 million to 18 million. Some investors prefer cold hardware wallets to centralized exchanges in their search for safety. Ledger, a startup out of Paris, aims to simplify that procedure from how it is right now. This entails capturing a cryptographic snapshot of the coins and tokens owned by a crypto exchange. However, proof of reserves only provides a picture of the assets of an exchange at a specific moment in time. According to critics, this paints an incomplete image of the financial stability of these companies. There is also a lot of discussion about auditing. Clients are classified as unsecured creditors on most cryptocurrency exchanges, including Coinbase, the sole publicly listed exchange, placing them in the same category as suppliers and contractors for commercial companies. Clients of an exchange are not entitled to any government-guaranteed compensation in the event of a collapse. However, this might soon change. The US, European Union, and British governments are putting in place frameworks to cleanse these markets. The necessity of such initiatives has increased with the collapse of FTX and other cryptocurrency platforms. People must be able to perceive that measures are being taken to control it. We can inspire confidence if we can provide some guidance. So, are crypto exchanges out of the picture? The majority of experts agree that they'll continue to function, but whether or not they survive will depend on how seriously they approach risk management, governance, and regulation. Cryptocurrency is here to stay. Crypto will eventually continue to gain popularity. Our future includes it, and it could be advantageous. In the long run, it benefits the company since it exposes dishonest people, fraud, and bogus value propositions that promise quick riches with centralized value propositions. The crypto winter may end in 2023, but there is no way to predict when the ice will ultimately thaw. Every company must be prepared for this market to last for the next 24 months. That's all for this video. If you enjoyed it, please like, subscribe, and hit the notification bell to stay up to date on our videos. And make sure to leave your thoughts in the comment section below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and keep learning. Until next time.